Welcome, everybody, to the Chinchilla Pickin' Podcast. It is July the 30th, 2023 at 4:07 p.m. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. My name is David Underwood, and I am joined once again by the one and only Brandon the Beaver. What's going on, Brandon?
Just still taking my vow of not watching CNBC. And I've also taken like an exodus completely from all political news. I haven't watched a thing when it comes to politics in the past month. I'm kind of interested in this alien testimony thing though, so I might look into that because I have no idea what happened with that because I haven't watched Fox News, MSNBC, CNN, anything. And by the way, my mental health so much better.
Yeah, I mean, as far as like just regular news, I just look at the headlines to see if there's anything that's affecting the markets or anything that's affecting any stocks I own. But as far as stock news, I do watch. I have a subscription to live TV, so I have Bloomberg and CNBC and Fox Business, and the three biggest ones available to me. I know this weekend I watched a great interview of CEO of investment firm, and on Bloomberg, and it was great, and I had a good conversation. And the CEO, Brandon, he actually talked about the housing market, the commercial real estate market, the real estate in general, and where, because his company is mainly invested in real estate, and where he thinks things are going, how things are going right now, and it gives you a good insight. So as far as what you're talking about, the talking heads spouting off things happening in real time, yes, that is typically those stations throughout the week, throughout the business, the market hours, but on the weekends there are great interviews happening and insights. And so I find value in watching it. I know you don't, but I do.
So that's great, but the thing is that you can catch that interview isolated by itself online, without having the talking heads surrounding that interview on both sides of it, and without the emotion and irrationality. You know what I mean? So I just watched an interview with Larry Culp. I think it was from CNBC, but I found it from on my TD Ameritrade account on the news section, and I just clicked into that and watched it. And then I also saw a good segment that actually CNBC did on Meta's earnings, and I watched that. But then I don't have on both sides, the emotion driven stuff that happens so often on those networks.
And I feel like so investors like yourself need that. Investors like myself who also day trade, we don't just do long-term investments. We need that news in real time to be able to make our trades, because there have been some times that I'm in and out of a particular stock in 1 to 2 hours.
Yeah.
And I've made 5%. So I need those real-time headlines. And then there's other investments that I bought in a year ago, Brandon, I'm still sitting on. So I mean, I have a good mixture of it, and I understand. I know you don't day trade, so for you that's not necessary.
Well, I just don't have like the ability to at this point in time. I really haven't for like 2 years with the job that I have now, and with the last 2 jobs I had before that. It made it really difficult to take time out of my day, because I always had something going on that was pressing, some sort of fire to put out somewhere, you know what I mean? And taking my time off to do that and watch a trade and making sure that it's going in the right direction and being that time centric on the day trade, just it's not right for me right now. When COVID happened and I was working from home, I was good. I could day trade, and I did day trade and swing, made swing trades and stuff like that on the market.
All right. I mean, at least you know yourself and you know your situation, and you're able to be disciplined enough to do what's best for you and your finances. I do want to.
It takes time to get there. It takes time.
Yeah. And that's good, because that's how you're going to make money, is being disciplined, knowing yourself, knowing what you're capable of doing, and then just growing. So I want to take a couple of things here. I know I said you'll go first, but if you don't mind, I got some short, tiny 2-3 minute things, two of them that I want to cover. But rules. Brandon and I get together 5 to 10 minutes before the show, and we tell each other what we're going to talk about. You actually hear the live discussion here on the show. Brandon has the meat of the show today, but I told him beforehand he would go first, and I lied. Here I am. I'm gonna stop you. But these should only take 2 to 3 minutes. It shouldn't really take that long at all. First thing is I want to talk about this a person that I was assisting helping get started in investing, right? And I mentioned this person before in the show, and they had set up $20 paycheck to go into their Fidelity investment account. That's how we set it up, and they've been investing now for a little over almost 2.5 months. So they haven't been investing that long. But in 2.5 months, they have gone ahead and they've returned an 8% return on their money in 2.5 months. And I want to, yeah, I know. That's what I told them too. I said, that is really good. And I explained it to them in this regard. I said, look, the best 401k fund that I've seen, that I personally have seen in all my years, and has ever returned maybe a 14.5% return on your money in a year. I said, that's the best 401k fund that I have personally found. A hedge fund will probably will get you about 35-40% return, and that's an average. So some are better, some are worse. And then there's capital groups that would get you a possible higher return, but those are, you have to have a certain net worth to join those capital groups. So I said 8% return in 2.5 months is awesome, because if you compound that and you do 8% return on your money for the next 2.5 months, and so on and so forth, I said you're doing really well over the course of the year, and you've really grown that into a tremendous amount that you're up there competing with that 30% return on your year, getting close to it. And I said, this is what I'm talking about, that anybody can be taught how to do better than what your 401k can. If you're just smart with your money and you stay disciplined and you listen to the advice that people have gone before you and you do some research. The problem, again, that I've seen when I get a new person and they start investing or trading is they have a few good trades and they're like, I got this. I don't need to listen to you anymore. And they go off on their own, and then they lose money because they quit listening because they got this. And what happens, and they say this doesn't work and it never will work, and they give up, and it's all because people quit being disciplined and quit listening to the people who have gone before. Find a mentor, find someone to guide you, and then stick with them. Find someone who's actually being successful and stick with them. Don't duck out. Brandon, thought?
Yeah, and stick to your thesis and to the investment knowledge that you've gained. I mean, I think my strategy actually works with what you're saying right now too, because there's been times where with Meta, I was sitting on a 15% loss at one point. And you know what I did? Just dollar cost average. I stayed true to what I thought about it and stuck to my thesis. The same thing with General Electric. Disney is probably going to wind up being the same way. I'm down on that right now, but a lot of people would buy it. Oh, I'm down on it. This isn't working. I need to sell it and take my losses and move on. But you're just going to keep doing that. You're just going to keep taking losses if that's the way that you are. And one of the things that I love about the show, Dave, we're talking about 8% in 2 months because we're reasonable people. We're not the TikTokers on there like, oh, look at the 7 Ferraris behind me that are totally mine and not Google stock pictures I found from somewhere. I made 2 trillion% in 3 weeks.
Yeah, no, you didn't. And if you did, it's fake money. I love because there's some sites that let you do paper trading, Brandon, and there's some sites that let you do binary options with fake money to paper trade, right?
Yep.
And I've seen people actually do video of saying, "Hey, look how much money I'm making." And there's that little symbols and stuff at the top that let you know it's paper trade. I'm like, you're paper traded money and making a video and saying that you're actually making that money, and that's fraud.
Yeah, it's
that's fraud.
Honest, but that SEC will probably never do anything about it because there's too many people.
They're not. And the loop around is if they don't sell anything, then technically they're not breaking any law there. So if they're not selling anything, then it's okay. That's the loophole. But anyways, I'm going to hand over to you. I know you got a lot to talk about, Brandon, so go ahead and get started.
All right. Let me pull up my notes real quick. All right. So Alphabet and Meta both reported earnings last week. Actually, looks like tech is doing really well. When we talk about the AI boom, it looks like there may be a little bit more to it. And Dave, ad spending coming right back up, still down 18% for ad prices digitally year over year. But they seem to be rebounding, and that might be going against my, estimation that we're going in a recession. Maybe we're not, I don't know. But Alphabet reported a 5% year over year growth in Google search ads. 4% growth in YouTube ads. Previous quarter, this was down. So starting to accelerate from zero growth. And this was on both ends of this. So that's good news for the general economy. So it's definitely good news for Google. Good news for Meta as well. Meta's revenue almost completely came from Facebook and Instagram ads here. This was 11% increase for Facebook and Instagram ads in the second quarter. And that's up 3% from 3% growth in the first quarter. So big rebound there as well. They had a 1% decline in ad revenue for last year. So starting to move right back up in the ad revenue. Third quarter guidance implies 25% revenue growth, the fastest pace in 2 years. And that's mostly, once again, coming from ad spend on Facebook and Meta. And I told everybody on this podcast, this is what I was going to be paying attention to. Ad spend. We talked about the Omnicom company that, the advertisement company that we mentioned. And then I was looking into the advertising industry. And then I also mentioned if I was going to buy anything because of advertisements, it would be Google or Alphabet or Microsoft because of the AI portion of that. Mark Zuckerberg mentioned Reels. He said it's generating more than $10 billion in annual run rate revenue. This was only $3 billion in the fall. So huge growth there as well. Now, here's an amazing statistic too. I think Google Cloud growth in the second quarter was 28%. Any kind of growth where you're looking at 20% or above for any of these companies that are well established and well matured, it's pretty exceptional. Go ahead, Dave.
Well, I mean, you saw a bit major cloud growth in Microsoft all of last year, quarter over quarter, continuing to grow, but they only have so much bandwidth. So people are going to move to the cheaper cloud service and companies such as Google, because Google has so much of the infrastructure in place that they're able to provide this product at a lower cost than, say, a Microsoft or an Amazon, because Amazon's still building out their infrastructure, but Google has an existing infrastructure that's pretty large. And so that helps Google keep that lower cost. And so companies will switch to the lower cost. And it's this, like you said, an established company, so they know they can trust the product.
Yeah, and Google, even compared to Microsoft, Google.com, that's got a 20-year head start on Bing.com. So they've got a lot more, in place to help them, I think, with even the AI thing, which a lot of people were thinking Bing would overtake Google for AI search results, and I don't think that's going to happen. I think Google's got too much of a head start on them, and they know what to do and what not to do a lot better as a result.
There's now with the AI, I want to separate that conversation from the rest of Google, right? So Google makes most of its money right now currently off of ads on YouTube and Google and the AdSense market and all that, and that makes them a lot of money, and it's very, very lucrative for them, and their profit margin is huge because they, like I said, they have everything in place already and it's all paid for. So their profit margin is massive on these ads. But the AI, I think, is a separate conversation because there's a lot of potential and opportunity there, but it all depends right now on the companies that are making moves if they're actually gonna exercise and jump on the potential, jump on the opportunity, and actually see the actual growth and existence of this AI market and the AI jobs.
Yeah, and a lot of people talk about the AI boom, and when you talk about Meta being up 88% year to date, they blame it, or not blame it, but they say that it's because of the AI boom that we're in. But these numbers that these companies are putting out right now on ad growth, I think they justify the current stock prices. I think both of these companies are currently fairly valued. I think Meta's at like a 20 forward PE. I think you're paying 20 times forward earnings. It's somewhere around 30 or 35 for the last 12 months earnings, but so fairly valued, not undervalued or overvalued there, in my opinion. And I think just when you're looking at like, okay, Google, or not Google, but Meta expecting a 25% revenue growth for the third quarter, that's why I think the stock's up.
Do you think that has to do with Threads and the whole Twitter versus Threads issue?
I honestly think Threads is, to me, honestly, as an investor, it's just kind of like it's icing on the cake. Without Threads, this company still is producing 25% revenue growth because most of it's coming from Facebook and Instagram. So
Gotcha.
Threads is just another, another reason to do it, but it's very small when compared to their core group of apps, which the biggest one's Facebook still, and then Instagram after that.
So I mean, because we have a Threads, Chinchilla Picking does, and it automatically, when I created the Threads, it automatically transferred anyone who was following us on Instagram all already over to our Chinchilla Picking Threads, and it was pretty interesting how it did it and pretty cool. And I'll be creating a Chinchilla Picking Facebook here soon. I'm having a little technical trouble with it. I'm not IT. I'm sorry. I'm not IT savvy, but the cool thing about Meta, and this has to go with Meta's advertising, is that when I do a post, I can post it to all three at once. And that's what a lot of companies and social media people like, is that, hey, I could do one post and it's on all three.
Gotcha. Now, on the flip side of this, Meta's virtual reality and metaverse business lost $3.7 billion. That's the Reality Labs. And this was a $4 billion loss in the first quarter. And they expect losses to increase substantially in 2024. Initially, we were looking at $10 to $11 billion in losses on this front per year when they announced Reality Labs. They're probably going to top that in losses, unfortunately, this year and maybe even next. So this is something that, like, you're talking about the year of efficiency, and they've decreased their head count, I think, by 14%, which for a company that's still currently employing 71,000 people, that's a lot of people that they axed.
Yeah, and the Reality Labs, the problem I see with that is they have a good product. They don't have enough apps, and they don't have enough games, and they don't in order to continually coming out. And the user base is there, but they're not connecting with each other like they thought they would. So let me explain this better. Say, Brandon, you get a Oculus headset, right?
Yeah.
Then you don't know anybody else that has one. So these multiplayer games that would be very exciting to play online in VR, you don't have anyone else to play with, and that's what a lot of people's problems are. However, the groups of people out there that do have other multiplayers to go with, they their complaint is there's not enough continuing to produce good content and games and apps on there. And then as far as the developer side and the business side aspect, that which is the new headset was geared at, is you don't have a lot of companies actually using it in the workplace because they don't see a way that they can use it in their current setup as a corporation, and so there's no adaptation there for it, and so that's the problem they have with it. I believe they have a good product, they have a good vision, and you just got to get the public to adapt.
And it's going to take time. I think we were looking at like 2030 or something like that when they first announced this as far as profitability goes. But the losses they've got to control. We expected losses going out for 10 years when they first announced Reality Labs. But this has got to be something like, okay, it's starting to increase a little bit. It's not going to affect me selling the stock. I'm not going to sell it at the moment unless, that starts to accelerate a lot more than what it is right now. But yeah, this is something that $3.7 billion in the second quarter alone. We're already up to $7.7 billion in losses for this year. So it's probably going to go above that $10 billion mark in losses that they were talking about earlier. So definitely has to be, stemmed, but people for right now are at least ignoring that a little bit. And Meta is back to being a loved stock, which is a great reminder. This is how quickly things can turn around. I mean, I don't think anybody on this podcast, well, a lot of people on this podcast probably don't even know or remember what Cambridge Analytica was. Like, if I mention that, hey, remember Cambridge Analytica? They're probably like,
Yeah,
what is that? It was one of the reasons
I
why
remember that.
and it was in the doghouse for so long because of that. And people used to love to hate it. This was, but it created profit opportunities for people like me and people who are like-minded, who picked up the discarded stock that people on CNBC were trashing, frankly. Look at General Electric. It was hated for so long. People like, that, or the once great industrial company that is just trash right now. If you want to lose money, you buy General Electric stock. Well, thank you to those who hated the stock when Larry Culp took back over, because you allowed me to take 62% profit so far. And this was, go back to August of 2021. We had a show that was called GE Past, Present, and Future. And I was talking about how I thought this was going to be the great American turnaround story. I'm not trying to brag about this, but we should celebrate our wins a little bit, right?
Yep.
So 62% now, not to mention the 40% profit that I've made off of General Electric's healthcare stock since its January 4th market debut. And this is basically all thanks to people like I'm gonna trash on him again, but whatever. All thanks to people like Jim Cramer, who were physically crying about how horrible Meta was, and allowed people like me and like-minded stocks to pick up huge gains in Meta. Now, let me note something here. I can't predict the future. I'm not a wizard. Even with my Meta investment that's almost doubled now, I even made mistakes on that. The first shares I bought of Meta were sometime around April or a little bit before that, I think last year. The first shares I bought were $338 a share. The stock still hasn't climbed above $338 a share, so I bought too early there, right? But thanks to the magic of a nice little thing called dollar cost averaging, and also thanks to a bit of experience that allowed me to hold on to my thesis and stay confident in my decisions, the secret sauce here was that it was dollar cost averaging and staying confident in what I was doing. And I loaded up way more shares in October, around $115, than I had initially bought at $338 in April. So this lowered my dollar cost average. This lowered my average on the stock to $166.99. I'm up somewhere around 95% on it right now because of that, despite my initial mistake of buying too high. Now, the first shares I bought of General Electric, they were around $80 a share, but we stayed confident in the thesis. Dollar cost average loaded up around $59, $60 a share. So you can see I bought at 80. It dropped all the way down to 59.60, and then it dropped again to around 54.55. Huge drops. I didn't take the loss because I was confident in General Electric and Larry Culp. I loaded up at 59.60. I loaded up at 54.55. G's now at $114.39 a share, above where I even initially bought it at 80 cents a share, or $80 a share.
Yeah, and I could also give the example of Tesla when I bought that last year on the show, and every week I was giving updates of how my Tesla position was doing, and I had a dollar cost average, and it eventually started moving up, and I sold it, and I took a smaller percentage gain than if I would have just held it longer. I lost out on longer gains because I wanted to hurry up and get out of it because I was impatient, because to me it was meant to be a trade, but dollar cost averaging helped me there. So you're right. In what we call DCA, or dollar cost average, and DCA works all the time if you believe in the company and the actual investment.
Right. So that, I mean, it's and then also if you can continue to believe in yourself, because it's oftentimes very hard, especially for newer investors, to stomach the fact that they're down sometimes even 20% on a stock at the moment in time,
Yeah, and Buffett's been down on a lot of his investments at one time or another by a good percentage, but he believed in them, and they turned out to be correct for him.
So there's probably a lot of people that turned on this podcast, right around the time where I was saying to first buy Meta, or right around the time where I was saying to first buy General Electric, and they paid attention to it for like maybe 2 or 3 weeks, and they were like, "Oh, this guy doesn't know what he's talking about." But if they would have stuck around for the long term, just for the way that my strategy does work, I mean, right now I'm down probably, I think, about 7% on Disney, but I'm not going to take the loss on it because I like Bob Iger, and I like the direction that he's starting to move the company back in. So hopefully, I mean, it may not be right. This might be a bad investment. It might be one of a few that were bad, but hopefully in a couple of years, I can turn around and say, look, doubled my money on Disney by
Right.
doing the same thing I did with Meta and General Electric and a few others.
Yeah. And you were right in the past, and you've been right before. So
It's all like, the thing is that you don't even have to be right all the time. You just don't, because a lot of your wins are going to far outshine the losses.
and yeah, and just to hammer this point home here, you don't want to try to outsmart the market. If you found something that works for you, just stick with that. Don't try to get the double extra shot with frap with the extra whatever sugar topping in it. Just order your coffee black. I mean, come on. If you know, it may not be flashy or cool, but if it's working for you, stick with it. Don't try to change it up.
So in a way, it kind of is a little bit outsmarting the market, only because you're buying discarded stocks that the market doesn't like, but you're not overthinking it. That's and you're not doing the what you just said with the palm reading and the
The Takoyaki cloud, or I forget, I
exactly.
mispronounce that all the time, but
Well, I
yeah,
don't
the
know.
cloud and reading the charts. I know a lot of people have done well reading those charts like that, and it's worked for them. It can never work for me. I look at those charts that they have set up with the MACD lines and the growth and everything else, and I'm like, hey man, if that works for you, that works for you.
Well, so you just
I
mentioned
was never able to read them.
You just mentioned the MACD line. That's actually one of the ones I do like. But it
Of
has to be
course it is.
combined. It has to be combined with a relative strength indicator and a few others for it to really work, right? Otherwise, it's going to fake you out. But there are a couple of different chart patterns or indicators that do seem to work and have seemed to work for me over the years. It could be just luck, it could be coincidence, but it seems to be the chart indicators that kind of align with investor psychology. And the ones that seem to work are the ones that measure the momentum of current stocks. So you're kind of, instead of value investing with those, your momentum trading stocks that are either in the process of turning around or already have. And those are really good for swing trades, but not really for investments.
Gotcha. All right, man. So Meta was what we were talking about. What's next? What's after Meta, man?
So I think we've got Apple coming up, right? Does Apple report this week or next? But I know their earnings are coming up. I think that if you're looking at ad growth, that should benefit Apple too, especially with Apple TV. I'm looking at I'm still pretty bullish, at least on the short term, for the tech sector. I think Google and Meta for the next week or two ride the momentum that was built off of these pretty strong earnings reports.
I mean, so you brought up Apple TV. I will give my thought on Apple TV. A lot of people got it when it first came out. They put it out there really cheap for you. You would T-Mobile even give it away free to their customers for 1 year. I did the T-Mobile free 1 year thing, and I tell you what, I did not keep subscribing. I closed it out after 1 year. I was like, I watched the shows I wanted to watch and just kind of said, I'm good. I don't need any more of this.
There's a documentary on the career of Steph Curry that I want to see on Apple TV. So I might become a Apple TV customer again for a day.
Well, I mean, there's too much competitions. I mean, you have like The Witchers on Netflix. You have Lord of the Rings on Prime. you got Apple TV with the soccer coach guy. I forget his name now.
I don't even.
Yeah, I mean, there's lots of but the average person can't afford all the different streaming channels. They just can't. Got Hulu's got his own programs. Disney Plus has his own programs. There's just too many now, and so not everyone can afford it. So somebody is going to end up being a loser here. As far as like, hey, that's the one that people start cutting, and I think it's going to be Apple, man. And
You do.
yeah, I think the Apple TV, yeah.
Well, I don't know. Do you think they want to take that loss? If they're sitting on quite the mountain of cash they can put to use if they need.
Well, I mean, yeah, they could keep it going at a loss every year for a long time. I
They
mean,
could, but
Apple's a cash machine.
they could grow it too. They could put that cash to use and grow in it. So I don't know, but right now you're right. It does look like if you're looking at even Disney Plus, like what Disney owns 67% of Hulu. There's so much leverage there that they could use and that they're probably going to use to put some life back into Disney again. So what's Apple
Yeah.
got? Apple's not
Yeah.
Netflix, it's not Hulu, and it's not Disney Plus. It's
Everyone talks about these Apple, not everyone, but like the pundits will mention an Apple show, and I'm just like, I don't know what that is, and I don't have an interest.
Yeah.
And that's how I feel. And I'm sure other people have felt the same way. When I ask, hey, do you have Apple TV? Do you have no one I know? Do you have Apple TV, Brandon?
I do not know.
All right, see, look, I mean, no one I know has Apple TV. No one. There's got to be a niche market that's watching it, and that's it. So, I mean, if it's enough for Apple TV for Apple, then hey, good for them. They found something. So,
I mean, maybe, but the thing is that Apple, that's not a reason really to stay away from the stock, though. It's just such an incredible company other than that,
yeah, I mean, Apple makes all of its money off the services of the cell phones and those, you got to pay for the cloud, you got to pay for the music, you got to pay for this, got to pay for that. That's how Apple makes all of its money, and it does very well.
We may be sitting in 10 years from now, we may be sitting here and thinking about how the headset haters for Apple were all dumb, and maybe we're all wearing headsets in the future. Who knows?
Foil hats, buddy. Foil hats. All right, so enough about Apple. Let me get into a headline here. I like this little part of the show where I've been like reading off headlines and just saying, hey, what do you think this has to do with the market? That's more of how as day traders do the macroeconomic events of the day. I just love saying macro. But yeah, let's go off some headlines. You ready, Brandon?
Go ahead.
All right, first headline is Apple bets on Vision Pro to repeat iPhone success, serves as game changer for AR VR industry. Apple is banking on his Vision Pro headset to revolutionize the AR VR industry, much like the iPhone did for mobile computing. And you were just mentioning this. What do you think about that? That Apple was betting on this VR tech now that you just dogged Reality Labs and where it's at, but you didn't really dog it. You did say their timeline they gave was not to be profitable in 2030. Apple's now jumping in VR saying, hey, this is going to be a future. Thoughts?
I mean, it could be. I don't know. If I was a time traveler, I would know better. But they clearly know. I mean, they're experts in what they're doing. Apple and Meta, especially Apple, when it comes to hardware. Meta has not proven themselves in the hardware. Their hardware division's been pretty bad, actually. But
their Oculus is a fantastic headset.
I
would disagree with you.
Not for money, as so far. And
I would just. Do you have a? Hold up, we're gonna disagree. Do you have an Oculus headset at all? Do you have one? Yes or no?
No, but look at the balance sheet. It's weighing heavily on Meta's balance sheet right now. They haven't found a way to make it profitable, and they probably won't for a while.
I have 4 different Oculus headsets, and I believe it's a fantastic product.
But it hasn't made the money yet. So we knew it wasn't. To be fair, we all knew it wasn't going to make them money yet. They've lost $4 billion in that area.
They're profitable off of me, I tell you that.
Just in the last quarter, though, total $4 billion in losses on
Gotcha. And that's development and research, and they're trying to grow certain areas that and yes, I have not seen the advertisements yet that you see on Ready Player One, and I have not seen the storefronts yet. I've seen a couple storefronts in VR where, hey, you could buy this Nike shirt for $5, and I'm just like, no, I don't want to. But I just started seeing those recently. So they have not been there before. So as far as ads and other forms of revenue besides just buying the apps or the games, that has just started. So I believe you'll see some growth there, but not the kind of growth that people were hoping for.
Not in the short term, at least.
Yeah, but Apple believes in it, and so I think that there is a future here. So Apple believes in it enough to create this. Next one, here we go. Ready? You're gonna love this one.
By the way, that's enough to convince me.
All right.
Apple believes in it.
Hey, the next one, you're gonna like this headline. This is a quick story here. Macro guru Raoul Pal predicts Elon Musk will use Dogecoin to make a global payment system for creators on X. So the rumor is Elon Musk is going to use Dogecoin, however you want to pronounce it, as the payments processor on X going forward.
Won't surprise me.
So I actually like this. I like that. I like this approach, and I believe that we need to use more of this approach. I like the cryptocurrency. I just don't ever see. I think some people use it as a, if you use cryptocurrency, you're of this political belief, and I don't like that because I believe because there are people on both sides that say they want a currency that's not controlled by a government or something like this on both sides, right? But yet both want to put the cryptocurrencies up against each other, and I'm like, why, guys? Let's just all start using cryptocurrency, and then we can move away from the yens and the dollars and the pesos and what have you, and move towards one currency if that's what you want. I mean, I think it answers everybody's concerns on both sides of the aisle. I think it's an actual unification tool, if you will, to bring people together.
Still very volatile, but yeah, I mean, if we could get there, I mean, I'll tell you what. Like here's something that is a little off subject, but maybe not. If we're all on one cryptocurrency or whatever, then I think the amount of wars in the world would probably decrease pretty dramatically.
Right. Like I said, it solves so many problems. And I think cryptocurrency is the best way to go there. But anyways, yeah, Dogecoin, more put in more use. I know Mark Cuban already uses that at his facilities and his companies. I know if Elon Musk has already used it briefly in Tesla's payment processing systems. I know if he's going to use it on X as well. The more that Dogecoin becomes, used everywhere, it should be a good thing. I don't know how to personally use Doge. I have some Bitcoin. I have a Bitcoin wallet, but Dogecoin, I don't have a Dogecoin wallet or how I would use it. But it makes me want to invest in Dogecoin as an investment, actually. So I don't know. You wouldn't invest based off that news?
No. It's not. It doesn't fit well in my portfolio personally. It's nothing against Dogecoin. It's just
all right. Next headline: as Ford loses billions on EVs, the company embraces hybrids. So if you read this article, this one's on CNBC. I know not everyone's happy about that, but it's on CNBC. But if you read into it, basically what it's saying is that Ford was not seeing a lot of people pick up their EVs, the Lightning truck. So they want to focus more on the hybrid model and not just the straight EV. First immediate thoughts come to mind, Brandon?
Oh, wow. More of a path cleared for Tesla.
That's where I thought too. But I think Rivian was happy to hear that.
Yeah.
Because the Rivian truck, the Cybertruck, Tesla's had way more orders than they ever thought with that. Now this just clears more of a way for Tesla and Rivian to move forward. But I think this was not the best move for Ford, considering that, most of the West Coast states are saying, hey, you have to be selling nothing but EVs by 2035.
Yeah.
Even though Toyota CEOs come out and say we can't do that.
Right.
But we'll do our best. Yeah, I mean, that's where they're going with those rules and laws. And so I don't know, man.
Well, Toyota's basically had the same focus, hybrid, not EV. And that's probably why, they've dug their feet in so much into that hybrid technology rather than the electric vehicle technology, and it's paid off pretty well for them. Don't get me wrong, but it would be quite impossible for them.
Yeah, and I like some of the Toyota hybrids where you could switch back and forth between just the electric part or just the gas part, and that would definitely help, especially with Tesla having the mileage issues on the dashboard. How the mileage was not being accurately shown there.
Well, Tesla didn't they just have a pretty big recall too for the front cameras being misaligned?
Really, I did not see that
I think
headline.
it was actually the Model S and the Model X, if I remember correctly.
Man, just they get those recalls in almost as much as Boeing has issues with their um their 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 pipeline of building the airplanes.
Right.
So but hey, we can't get rid of Boeing, right?
No, unfortunately not.
Yep. Those were the quick headlines I had here. There was something here about it was under the Bears section of the headlines. Oh, here, yes, we'll read this. Kathy Wood is losing hope with Chinese stocks. What's causing the rift? That's the headline. So this article is by Shanti Rexline, and she was going on to say that ARK Innovation ETF has exited Chinese stocks, including the Alibaba, and amid regulatory crackdowns in China. I think she's about 6 to 9 months too late on this one.
Yeah, I feel like the regulatory crackdowns peaked a long time ago, and even now Jack Ma and his aunt, they're restructuring to actually IPO on the Hong Kong market, which was something that a year or two ago people thought would be impossible. So
I think that the crackdown actually happened back when I was talking about Didi, and Didi came out and just listed in the U.S. and the government at the time was not happy with Didi doing that. And then we on the show we started explaining, oh yeah, okay, this is how Hong Kong stocks are actually on the U.S. market. You're not actually buying the stock; you're buying it through a regulatory through the Caribbean islands, and they're buying the stock on the Hong Kong market. And it was this whole mess of how these things were working. And then we explained it though in detail on the show. We took about 15, 20 minutes explaining it, how it works. This is what's going on, and here's where China is not happy. China's trying to set up another stock exchange in China to compete with the Hong Kong one. And they wanted their companies just to list on those first before going overseas to other listings. And I believe that's when the crackdowns were first happening. And that was the time to sell. And that actually was the peak of Jack Ma's company, Alibaba, at that time.
yeah, and China was a mistake for me personally. I was
Yeah.
pretty bullish on it at the time.
You were very bullish. I think we even had like a red stocks or something. We titled a show that one time or something along those lines.
Yeah.
Look it up, listen to it. You can hear a bull in a China shop was what it was called.
It was. Yeah.
Bull in the China shop, and Brandon
have to bring that up.
Hey, you talked about how it was bad deals, and you explained why you were getting out.
And even when we were getting into it, I listed headwinds and said the risks. So at least there was that.
At least there was that. All right, the last one I'm going to read here. Hopes of a Goldilocks economy and rate peak as buoyant U.S. stocks. And this was late Friday night on Reuters. Has put this up, and he's explaining that this was the reason why, in their mind, why the market was up last week was hopes of a strong economy and lessening rate hikes. Now, I want to say I was bullish on the economy, but they announced the GDP number and it was what, 2.8, 2.9?
Yeah.
So I keep bringing this up, and here's why. Back when the bill was passed and it was the infrastructure bill plan that we're going to spend, X amount of money, but it was going to come out tax dollars, right?
Yep.
Janet Yellen came on TV and said on TV, and it recorded, that for us to effectively pay for this bill, we need to keep GDP above 5 for the next few years in order to maintain the tax revenue to pay for the bill. Well, GDP went down negative just the next year, and then has remained low. And now we were celebrating a 2.8 GDP last week, even though at that time when Janet Yellen said this, the GDP was 5.8. So that shows you the wild swings in the markets. And then that tells me that if she was the Secretary of Treasury was coming on TV saying that's what we need to pay for it, it means we're not paying for it, that we are actually going in more debt to continue to pay for this bill because we were not hitting our GDP numbers, if my math is correct. So that makes me worry more about inflation, because then we're going to have to print more money in order to pay for these. So my concern about inflation still being there and the Fed raising more rates later on is a concern, but I'm still bullish on the economy. I'm still 60% bull.
So I'm still 66 or 60% bear, 70% maybe even. But let me explain why. Let me explain to you why. We just had a really great quarter, right? GDP, big victory lap on it. I don't really know that there should have been because of what you just said, and then national debt is at dangerously high levels. But when the regional banks started to fail back in March, we injected, and I don't think a lot of people talk about this, we put about $300 billion back into the financial markets. And now the Federal Reserve is starting to lower that balance sheet once again. So these bank earnings that beat the consensus and beat the estimates in the past quarter, and even some of the corporate earnings that did it too, this could just be riding off the $300 billion that was pumped into the market to save the regional banks. And once that's gone, we might just be continuing down the same path that we were back in March when the regional banks started to fail in the first place.
Well, part of that balance sheet that the Fed picked up was the Signature Bank loans, and they are trying to put that up for sale. $18 billion from during all that mess, Signature Bank and everything we were talking about on the show, and the wild swings in the regional banks. They're trying to put that up on the sale to recoup some of that money. But $18 billion worth of loans is going up for sale to any other bank at this time. I don't know if JP Morgan's going to come in and purchase any part of that. I know they looked at it when this all first happened and decided not to at that time. Maybe now they could get it at a discount, though.
Yeah.
Maybe they could get it at 60% of the dollar, 60 cents to a dollar. That might make it worth it to them.
Right.
But then the U.S. government ends up losing money on the deal. They're the backstop again,
which they don't care. I mean, honestly, they don't. It's not going to put the U.S. government out of business that they lose money.
Well, that's neither here nor there. But the regional bank problem is still going to exist going forward because of all the Fed raising rates. It's going to cause a problem for them.
Yeah.
Yes, but the stress test they did recently shows that the banking system can withstand. I think what I announced last week was it it was hundreds of billions of dollars of loss, and they could withstand it. And so the stress tests work. They can withstand some losses and still maintain operations.
Right.
So the U.S. banking system is solid, is what that means.
That's what we think.
Yeah, but we just don't want it to go. Yeah. You don't want it to go over $1 trillion in losses, because then now that's more than what they can take.
And let me be clear too. We just talked about quick turnarounds in stocks. The same thing happens with the macroeconomic economy. So even if I'm 60-40 bearish and or 70-40 or 70-30 even, and I think we're going into a recession. Look, the majority of recessions, they last between 2 months and 18 months. And 18 months, the very high end, and that's very rare. So I stay long-term bullish U.S. economy, stay long-term bullish for the S&P 500, and you're going to most likely come out on top because those recessions are very quick.
There you go. Last week, final thought, Brandon.
Final thought was actually just that. I just kind of burned through it. But yeah, it's very quick. Stay bullish. Time in the market is better than timing the market. That's a saying that somebody once said. It wasn't me, but it's true.
There you go. My final thought is I still believe RIG is overvalued. I still will short that. I'm holding on to some of my other positions, holding tight. Listening to Brandon's sage advice there. I believe Apple's going to break 200 this week on the earnings. If it stays right at 195, it should burst around 200 because Apple always, what's the word? They say they're gonna come in bad, but then they do end up doing well. So yeah,
they shoot for the moon and land in the stars.
yeah. So Apple always has a tendency to do that. So I think they're going to break 200 a week. So that's a good trade. 2.5% return, not bad for 1 week.
Guidance on Apple is always very conservative compared to what they do.
Right. Yeah, and they do that on purpose, and they're known to do that. I'm definitely looking at the cryptos, especially Dogecoin off the news that Elon Musk, because if Elon Musk actually comes out and says that, you might see a 10% jump in those. And so that's what I was talking about. Might be a good investment for me as a day trader. I'm eyeing it. It's on my watch list. I'm not saying for sure go out and buy it. But it's just let you know where my mind's at, how I think and how I make the moves I do. So there you go.
How long?
All right, man.
How long would you hold Doge for?
I would do it as a day trade to a swing trade, so probably 5 to 10% return.
Okay.
All right, guys. As always, we hope we've been entertaining, educational, and uplifting because we want everyone to make money. Have a good night. Thank you for listening.
Have a good night.